rising stocks, falling sentiment, and what that tells us about where the markets might be heading. Let's ask Dan Greenhaus of Solus Alternative Asset Management with me here at Post 9. Welcome back.
Thank you, sir.
That's interesting to me that we have this resilient market coming off the best week since November, stocks rising again, and I feel like sentiment is slipping, deteriorating. Is yours? Are you bullish still or less so? What's the story?
I think I feel pretty much the same. We had talked the last couple of weeks that the market was, I hate saying due for a correction because that, of course, means nothing. But it felt like the internal technicals suggested that perhaps we were running out of steam. And we did. And we were down, call it a little over 5%. I thought we were probably going to get down 6 or 7%. That would have been a more substantial decline. Although, really, what's the difference between 5 and 7%? We're splitting hairs here. But it feels like the market wants to stabilize at this level. Earnings season is coming pretty well. But obviously, you have the Fed on the horizon, and that's sort of a broader damper.
I mean, I've got, technicians out today saying, well, we're going to fail and turn lower. RBC says the pullback may not be over. JP Morgan's looking at summer drawdown risk, looking at a year ago and saying, oh, maybe we're going to be in a similar scenario. That's sort of to my point of, yeah. Well, I mean, the market bounced back pretty sharply, but yet it feels like sentiment is offsides.
Well, I think we spent 2 or 3 months going straight up. And all of a sudden, we were down 5%. All of a sudden may not be the right way to put it, but
it felt like that, though.
It did. And I think people got a little shook, and there's a feeling like, as I just articulated, maybe we need a little more than a 5% pullback. And so the fact that the pullback is, quote, only going to be 4% or 5% or 5.5% might be insufficient for a lot of people, which is why they may feel like I need a little more.
I want you to listen to something that Adam Parker told me today on halftime about his new note. The headline is, and then we'll play this down, the headline, our recommendation had been that the bull case was far more probable than the bear case, driving our judgment that there was material upside to the S&P 500, but now our view has changed. He told me why.
The 3 pillars to the bull case were easy financial conditions, gross margins expanding, and a belief that earnings are going to grow. The 3 pushbacks we always worried about were kind of a tightening set of conditions, slowing consumer, and a China recovery that's pumped. We could get some cyclical pressure on inflation a little bit. 2, the consumer is definitely slowing, and you can see that through some of the corporate earnings and macro variables. And then 3rd, we scoured every word of every earnings call transcript year to date for any mention of China growth, China demand, China initiatives, and it really hasn't picked up.
What do you make of this? Do you think the 3 pillars, to use his phrase, are weakening?
I understand what Adam's getting at, and Adam's obviously one of the best market watchers there is. I mean, my view of things is over the last week and change, let's say, revenue expectations with reporters has only gone up, called 50 basis points. But EPS expectations have jumped by well over 200 basis points. So from the margin standpoint for the market as a whole, you've seen some support right here. Now, granted, a lot of the heavy lifting last week was done by Meta and Google, et cetera, very large companies. But when you look up and down the spectrum of sectors, I don't really notice, other than healthcare, which is suffering from the Bristol-Myers issue that I think most people know about by now, most of the sectors seem to be holding in there pretty well on an EPS expectations basis. And that, I think, has a lot to do with margins. So at least from that standpoint, I think the market's doing pretty well.
Pasquarello over at Goldman put a note out that says, he expects the market to chop around a bit. You're going to have, maybe volatility pick up a little bit. He says, quote, there's times to go for the brake and times to go for the gas. Superficially, my instinct is equity people should be tapping the brakes. Yeah, now, this is a person who's been pretty bullish, too.
Sure. And listen, I think Tony's great, and I think he's probably right. And what I mean, leaving aside what Solus is doing with the fund or not, when you look at the size and the scope and the scale of the rally off the October lows, and then you layer on top of it the stickiness of inflation and what will probably be an ongoing shift in the Fed's narrative coming from Jay Powell at the meeting later this week, I wouldn't be surprised to see some dampener on the market for a little period of time.
Is that what you think? You're going to get a change in tone or a change in language?
Well, I think you've already had it. I think what it's shifting to the Fed meeting later this week, and we're going to bring in someone else.
It starts tomorrow. So
yes,
it's right. Going to be front and center here.
Sure. But I think it's going to be hard for him to say, as he had been arguing, that the data was going to shift in a way to give them confidence that inflation was returning back to 2%. And when he has the press conference on Wednesday, my expectation, and I think everyone's expectation, is is that he'll make a dissimilar comment, which is that he doesn't have that confidence right now, and that's going to continue the shift in the narrative away from we want to cut by, or what sounded to us like we want to cut by the summer, to something that'll be interpreted as we just don't have enough data to cut by the summer.